My name is Chris Tankey. I'm a Vice President here at HNI Risk Services located in New Berlin, Wisconsin. My background, I've spent the last 20 years working with transportation insurance. The last 16 have been at HNI. I lead our practice here in Wisconsin. Prior to that, I spent 4 years working for a trucking company in operations, being a dispatch and dock supervisor. So trucking is in my blood. Taking a look at today's agenda, we're going to take a look at the difference between a hard and soft market and why it matters, how to best tell your story to the insurance marketplace, how does my company get the best rates in the marketplace, how to reduce your company's insurance dependency. That's something we here at HNI feel is somewhat unique to us, and also some long-term risk strategies to help you manage. So hopefully this cartoon does not illustrate how your relationship with your current insurance agent or broker works, but unfortunately in many cases this is somewhat of the relationship. So let's start with some basics. Rather than bore you with a Wikipedia definition of insurance or anything like that, I decided to boil it down to really its most basic element, which insurance is a financial vehicle that allows companies to even out cash flow when hazard loss occurs. So you're going to pay the insurance company a fixed premium or a premium based on exposure throughout the year, and in turn that insurance company is going to pay losses that happen during that policy period as long as they're under the policy limit. So let's take a look at a couple of examples. So for example, loss of property, and that would be a tractor fire, as you can see in the upper right hand corner. If that tractor was worth $150,000 and it looks like the one in the upper right hand corner, that insurance carrier is going to issue that check for $150,000 rather than you as a company having to do that out of your cash flow. A loss to a third party. So for example, if one of your drivers would rear end a private passenger car on I-94 in downtown Chicago, resulting in some bodily injury, which resulted in a claim payout of $400,000, the insurance company would do that, and you are paying your premiums in consideration for that. Same thing really with a loss to an employee, really referring to an injury there. For example, a broken leg, a hand that looks like the one on the right-hand side of the screen. So we'll talk about common types of trucking insurance. This is not meant to be all-encompassing. Within the time frame that we have here today, we're going to touch on some very broad areas. Certainly willing to dive deeper, and my contact information is on the slides, or you can feel free to call me or email me at HNI. But some of the common types of trucking insurance we're going to talk about are auto liability. Auto liability really is bodily injury or property damage, or both, to a third party. And the way to think about auto liability is if it happens with your truck, if it has wheels on it and if they're moving, a loss would fall under that auto liability bucket. Physical damage is really the insurance to insure the loss to the property, the tractors or trailers. Cargo, third-party goods while they're being transported or actually while they're under a bill of lading. Workers' compensation would cover either medical bills and indemnity to an injured employee. Indemnity being lost wages and or permanent or partial disability awards. General liability, just like auto liability, liability would be bodily injury and or property damage to a third party. And notice here I wrote premises and or driver. So for example, the difference on a general liability claim, Maybe I'm walking across your parking lot and there is a big patch of ice, and I in turn slip on that ice and break my arm, and I say, you know, I'd like you to pay for my medical bills. You submit it to your insurance carrier and they would cover that under general liability. Actions of your driver would also fall under general liability. Not all actions of your driver, but I'll give you a very specific example. So your driver's at a loading dock and he happens to hop on a forklift, loses control, and drives the forklift through a wall or off the dock. That customer is going to say, hey, your driver damaged our forklift. That would be under general liability. The last one we'll talk about is umbrella. That provides additional liability limits. The important thing to note about an umbrella is that it does only extend over liability coverage, which would be auto liability, general liability, and workers' compensation, a coverage within that called employer's liability. So it does not extend over cargo, nor does that extend over any of the physical damage coverages. Okay. So parties involved in the renewal process, this is fairly obvious, but I think I felt the need to illustrate this because I think sometimes there's some blurring of the lines between agent and the insurance company. So obviously the trucking company is a necessary party in the process, and that trucking company is going to be paying the premiums, incurring the losses, and really the exposure to be insured. The agent is an intermediary representing the trucking company to the insurance marketplace. In the insurance company, for example, like HNI, an agency, insurance companies are going to be the ones setting the rates, collecting the premiums, adjusting and paying for the losses. So an example of the insurance company may be somebody like Acuity or Great West. Independent agents represent multiple insurance companies. There are very few direct writers still out there today. So the agent can represent multiple insurance companies. Let's talk about how the insurance companies set their rates. I'm sure some people feel that there is a little bit of magic involved in setting of the rates. Leaning the underwriter and the actuaries leaning way back in their chair and closing their eyes and coming up with something out of thin air. But in all reality, rates are based off actuarial sciences. So the law of large numbers come into play with that. So I'll give you a good example. In workers' compensation, all the insurance providers throughout the state are required to submit their payrolls and their losses by class code to the state bureau, who does employ some actuaries. They analyze the exposure and the losses on a global scale within this state to come up with the recommended rate for, let's say, long-haul trucking to be charged in order to make sure that it's a fair rate, that it's not overcharged or undercharged, and the companies are able to cover their fixed cost and losses and also make a profit. Now, on the auto side, what happens is the insurance carrier, they aggregate all their losses. They take a look at exposures and, again, do a lot of number crunching to come up with their base rates. And in fact, there is a rate that is on the auto side of the equation where underwriters have come up with a burn rate. I don't know that off the top of my head, but basically, if they're going to write coverage at less than this rate, excuse me, they are not going to make money in the industry. And that changes every year depending on losses and exposure and all that stuff. So insurance companies, it's a for-profit business, obviously. They're going to take a look at and collect the premiums. pay out the losses, and they also have to pay fixed costs. So the cost of their facilities, the cost of their adjusters, the cost of their phone operators. What's at the end of that is the profit. A lot of people think that if I paid in $100,000 and the insurance company paid out $99,000, the insurance company made $1,000 of profit on my account. In fact, that's not the case. You have to account for fixed costs in there, and what most insurance companies would tell you is that to run at a profitable rate, they're looking at a loss ratio of somewhere between 60 and 70% in order to make a profit or even break even. So, in addition to the actuarial sciences, what else can influence your rates? And really, in my opinion, there's three major things that can influence your rate. That would be market conditions, risk characteristics, and what I call risk incompetence or risk excellence. So let's look at market conditions. Market conditions vary year by year, and the insurance industry has some real nice graphs showing the time cycle of hard markets and soft markets and things like that. But I call a hard market really a risk underwriting mode. This is really focused on writing accounts on a profitable basis, and you would think that normally they would want to write it all the time that way, and that's not always the case. But in a hard market, it is. The risk underwriting mode, typically higher premiums are involved, a more stringent underwriting criteria, so whether that be losses, cargo, age of drivers, things like that. Also, there could be some coverage form restrictions. For example, in cargo, there could be an exclusion for driver error, or it could be a detached trailer exclusion for theft. A hard market also has less insurance company competition. So there's less companies out there competing for your business. On the other side of the coin, we have soft market and what I call cash flow underwriting. So the insurance underwriters aren't really all that concerned about your profitability. They are concerned, but it's one of the factors. They're more looking to get the cash from your premiums to invest in a market. So there's two ways insurance companies can make money. The first way is obviously underwriting profit. The second way is investment income. In a soft market, the cash flow, the returns that the insurance company are generating are going to be large enough to be able to offset some of those underwriting losses. So in a soft market, it generally results in lower insurance premiums, reduced underwriting criteria, more broad coverage, and increased insurance company competition. So the second thing that could affect your rates are your risk characteristics. So one question that an underwriter will ask is, what is the radius of operation? Looking at the two pictures on the screen, it kind of illustrates the difference in risk. So radius of operation, or even areas of operation, the picture on the left with the truck in a fairly rural area, no traffic around, versus I would imagine that picture is somewhere in California with thousands of cars, maybe hundreds of thousands of cars on a 10-lane highway going both ways. Those are two substantially different risk categories, and obviously an underwriter is going to look at, as they should, the picture on the right is a very higher risk than the folks that are running maybe in an area like the picture on the left. And now that's an extreme example, but I think you get the idea. So type of cargo hauled. Are you a dry van carrier hauling corrugated cardboard where there's not really much chance of loss or theft? Or are you hauling one-of-a-kind artwork, cigarettes, alcohol, tobacco, things that are very much commodities in demand in the community of criminals to be able to sell on the black market? So from a work comp standpoint, one of the things the underwriter is going to want to know, does your freight require material handling? So let's think about this. A dry van, if a driver is not responsible for loading and all he does is bump a dock, the work comp exposure that he has is in essence getting in and out of the truck. If it does require material handling, the driver's in the back of the trailer unloading, that's a substantially different risk than the drop and hook driver. One area in workers' comp that is particularly risky from a trucking standpoint, really there's two, would be on a flatbed and a tank truck operation. A flatbed, you've got the tarping, chaining, climbing up on the trailer without sides, which could result in a fall from elevation. We've seen some pretty bad claims in flatbed, and more frequent claims in flatbed with falls from elevation, legs, shoulders, things like that. Now, tankers, you'd say, well, wait a minute, tanker, how do you load a tanker? Well, it could be dragging the pneumatic hoses, but what a big concern is from the insurance underwriting community is a fall from elevation. If that driver is required to get up on top of that tanker, if they would slip and fall, they may result in a pretty serious injury, and we've unfortunately seen a couple of those, and it's not been good. So the underwriter's taking a look at all those things. Now, risk excellence versus risk incompetence. The underwriters are given base rates. They do have then discretionary debits and credits that they can apply to your account. I've listed a few things that are taken into consideration. This isn't meant to be an all-encompassing list, but just a general list of things that underwriters will take into consideration when looking at an account. So a 5-year loss ratio. They're also going to look at a 1 and 3, 5-year loss ratio and trends, but the 5-year loss ratio takes the total amounts of premiums you paid and total losses divided by total amount of premium. That will give the underwriter a snapshot to tell them if your account has been profitable over the last 1, 3, 5 years that they're looking at. The second thing would be claims frequency versus severity. There's a saying within the underwriting community that frequency breeds severity. Your account is going to be looked at very differently if you would, for example, have in a 1-year time frame, have a one claim of $1 million versus 10 claims of $100,000 each. Right or wrong, it's the same dollar paid out, but it's a very different look from an underwriting view. CSA scores are also taken a look at. Now, whether that's right or wrong, I guess it's, I'm not here to defend it, and I'm not here to advocate for it. But the fact is that the CSA scores are looked at by the underwriting community, and your company is judged on how those scores look. In some cases, if you have more than 2 categories over a threshold, that throws up major red flags. And the underwriters have gotten pretty savvy as to those tools online, and they will look at your violations. They will look at speeding tickets. They will look at log violations, drug violations, and get a general feeling of your company from the CSA scores. Again, I'm not saying it's right. I'm not saying it's wrong. I'm just stating that the underwriting community does look at CSA scores when underwriting. They will also look at driver MVR profiles, age, experience, and violations. Most insurance companies are looking for a minimum age of 23 years old, 2 years experience, and no more than 2 violations in the last 3 years, and certainly no major violations in the last 5. Major violation may be a speeding excess, which would be defined as 15 miles an hour over the speed limit, a drunk driving, reckless driving, use of a handheld device while driving. Now, some of the things, and just to pause here for a second, as far as the MVR profiles, some of what shows up on a CDL driver MVR is their personal violations. We hear all the time that that speeding ticket for 15 over was in their car and not in their truck. I'm not here to say it's right or wrong, but the underwriting community looks at that speeding ticket and says it's a speeding ticket 15 over. We don't really care that it was in the truck or in the car. The fact is he had it. It may indicate the driver's got a heavy foot, and it also may indicate something along their lines of responsibility. I'm not here to defend that. I'm not here to advocate for that. I'm just telling everybody today that is something that's taken into consideration by the underwriting community. So safety programs, whether they're formal or informal, are looked at. Technology is a big thing that is out there today. Collision avoidance, the cameras like the Lytx or Drive Cam or lane departure. Now, we get asked all the time, if I install technology in my truck, will I get a specific credit on my premium for installing this technology? In most cases, the answer is no. And the reason for that is the underwriters will say that by installing that technology, it will reduce claims and you will see better rates long-term by not having claims due to this technology instead of giving a credit upfront. Again, I'm not here saying it's right or wrong. I can see both sides of the argument. I'm just presenting how the underwriting community takes a look at that. Management attitude, proactive versus reactive. If the underwriter would send out a loss control professional to do a pre-inspection or a renewal inspection, one of the things they're looking at is not only your raw data for loss ratio, CSA, etc. They're also gauging the attitude of the management. Do you buy into safety? Is safety taking a backseat to operations? So attitude is a very underrated underwriting characteristic that is taken into consideration. So, things we just looked at. If you were investing your own personal money, what would you want the trucking risk to look like before you agreed to insure that? So what factor would carry the most weight to set the pricing? So if we go back one, if it was your own personal money, I'm pretty sure that some of these things would carry pretty heavy weight when you were looking to either take on somebody and insure them or decline that. So just a question to maybe think about. So let's talk about underwriters. Underwriters are somewhat of a mystery to a lot of people. But we'll talk about what they do and a little bit of how they do it. So an underwriter's workload in a typical month is probably 50 plus submissions of new and renewal business. They're not just sitting around waiting for the one submission to come in to get on it right away. They're typically dealing with multiple agents, in some cases multiple agents in an area or multiple agents across the country. All those agents believe that their accounts they're sending in are the best and they want the best rates, and so the underwriter is fielding multiple calls from those agents. Most of the insurance business on the property casualty side will renew the first of the month, and sometimes on a quarterly or calendar year. So on a quarter or calendar year, that underwriter may be particularly busy. This is important to take into consideration when your agent is requesting information from you, and they're doing it either 120 or 90 days out from your expiration date. It's important to get that to them as soon as possible. That underwriter, like I said, is not sitting around waiting for the one submission, and when it comes in with 1 week left, that underwriter in some cases is not able to properly underwrite, nor are they probably able to apply all the discretionary credit that is available because they're not comfortable with that risk. So, given the demands of the underwriter, how do we get your submission to the top of the underwriting stack? So, how does your agent submit your information? Is it just a pile of papers and a binder paper clipped all together with facts and figures, or is there any organization to it? Is it easy for the underwriter to be able to work with? And when an underwriter sees a submission come in and it's a pile of papers, that's time consuming for them versus having some organization to it that is easy to work with and is very efficient. The underwriter will always look at the ones with the organization and that are easiest to work with first. One question that we get as an agency when we're talking to the underwriters about a risk, why are they looking? And there's a couple different answers. One answer that we hear from either clients or prospects or whatever is we want to keep our agent honest. To be honest, that's probably not a great answer to an underwriter. An underwriter says, well, so I'm not sure if my effort that I'm going to spend on this account is really worth it in order to keep their agent honest. How do I know that they're not going to take the number that I produce back to their current agent and to see if they can match? Another one would be, we're looking for a better company. We're looking for a better partner in insurance to partner moving forward. That's a much better answer that an underwriter can buy into versus we're looking to keep the agent honest. So from your perspective, from the trucking company perspective, we'll just do a quick illustration with that. So if you had a very large prospect that you're looking to haul freight, and they called you in and said, we want you to bid on our freight for these particular lanes, the first year you'd probably be very excited, put everything you could into it, and at the end of that process you don't get the business. Oh well, maybe we could have been a little bit more competitive here or there or whatever. So the next year you get that same call, and you put the same amount of effort in and you find out, hey, all they're doing is taking your rates and driving down their current provider. All of a sudden that feeling of excitement that you had the first year doesn't necessarily translate to year 2, 3, and 4. You're not excited to work on it, and in fact, In some cases, you may refuse to work on it because you don't need to practice quoting and your time is very valuable. Same thing in the underwriting community. The third thing we want to take a look at would be selling your story with a narrative. Everybody, I don't care who they are, loves a story. Sell your story with a narrative. Tell the story of your company. Now, it might be quite simply on your website, and that's okay. But selling your story with a narrative and with the submission, it's very attractive. It makes the account come alive. The underwriter is in their cube in an office, and they have, in some cases, they've never seen your account. They have no idea what it looks like, no idea what your equipment looks like. So a narrative helps bring that alive. Now, with every account, there's always positives and negatives. And so, for example, a positive may be CSA scores are all way below threshold. Well, let's accentuate that. Let's tell a story on how that happened and how it's going to stay that way, versus a negative, which would be having a couple CSA categories over threshold. Rather than hoping that the underwriter doesn't see those particular metrics, I think it's best to address those with an action plan. Point them out, say, here's an action plan, here's what we plan to do about that particular problem within our company. I think it's much better to address it head on than to hope that they don't see it. So, who ultimately controls your insurance rates? Believe it or not, you do. You as a trucking company owner, executive, safety director, driver, you guys are the ones controlling your insurance rates. The way to do that is have the best claims experience in the industry, the best safety programs, the best driver MVRs, and CSA scores. And then work very closely with your agent to craft the story to sell that to the underwriting community. If you have those things, you sell it, you will have the best rates in the industry. So HNI is somewhat unique in that we advocate actually our clients buying less insurance. And that kind of sounds a little different. Most insurance agents, it's no secret, you get paid on selling insurance policies, but we would really prefer to have our clients take some ownership in the risk and reduce their insurance dependency instead of increase insurance dependency. We believe there's 4 steps to doing that. So the first one is really defining your insurance dependency. I mean, do you feel like every year, no matter what I do, the insurance underwriters raise my rates? If that's the case, your dependency may be on a little bit heavy side. So an example for dependency would be foreign oil. If Saudi Arabia cut off our supply of oil, would our economy be vulnerable? Absolutely. So if your insurance company would double your premiums, would that make your company vulnerable? My guess is yes. So in order to define it, we need to really determine our current level of addiction. So what is our culture? What does our culture say about it? Is management really bought into the fact that safety should be a value versus a priority? Now, a value and a priority, it sounds very similar, but they're different. A value is something that doesn't change no matter what. A priority can change depending on circumstance. So people that are out there saying safety is priority 1, I mean, are they really saying that safety is our first priority depending on the situation? Or should safety really be, safety is our top value, and we will value that above all else within our organization? I would suggest that safety being a value is probably a little bit better. Also, take a look at your results. I mean, if your results are you're not having claims, then maybe you should be looking at taking on a little bit more risk. If your results are you have a lot of claims, a lot of frequency, a lot of severity, you probably have a pretty big addiction to the insurance industry and the insurance products, and maybe rightly so, but we need to change that. The second step would really to be own it, and that's taking the ownership of risk. So in your organization, have you ever heard the phrase, after a claim, well, I guess that's why we have insurance? My guess is most of you have. That's somewhat of a fatalistic approach. Taking ownership of risk is we can prevent any and all claims. We have insurance for catastrophic events, but really we should be able to prevent any and all claims. So as far as owning it, one important thing would be to determine the level of risk that you can afford to take. Now there's two areas that I want to poke around in a little bit here. The first being financial. I mean, if you're a 20-unit fleet, taking a $500,000 deductible or self-insured retention is probably not practical. Now that's an extreme example, I realize, but you need to be able to handle the amount of risk you're taking depending on your own particular financial situation. If you can't afford to take much risk, then you shouldn't. Probably another area that I think is underrated is the mental aspect of owning risk. Can you sleep at night knowing how much money or how much skin you have in the game on the insurance program? So if you have a $25,000 self-insured retention, meaning that you are on the hook for the first $25,000 of any one claim, can you sleep at night? Is that okay? Are you comfortable with that? Could you write that check tomorrow? Is it going to, it will be painful, but it won't affect the ongoing concern of your company. The mental comfort, I would suggest, is also as important as the financial level of comfort. So the third area would be to really start attacking it. In order to attack it, we need to know our current performance. What are the leading indicators and what are the lagging indicators? I would suggest some of the leading indicators of performance may be results from something like DriveCam or speed gauge on PeopleNet. So for example, a leading indicator for a driver level of risk may be the fact that they have multiple panic stops every day as shown up on speed gauge or DriveCam. That leading indicator may show us that that driver is going too fast and following too close, which would be a leading indicator for a rear end collision. It would be my suggestion that we'd use that data to coach and counsel that person to change their driving habits, or if they can't change their driving habits, we may need to coach and counsel that person out of our organization. The lagging indicators to me really indicate claims performance. What has our claims performance been? Frequency, severity, what's preventable, what's non-preventable. Taking a look at those leading and lagging indicators should lay out a pretty decent plan for you to attack it. So here are some strategies to attack your insurance dependency. Starting at the beginning, looking at the driver standards and hiring practices. Today in the world of driver shortage, are we bending to get anybody who can fog a mirror in that seat to move a load? Ultimately, the ones that are behind the wheel and in control. it would be my suggestion from a risk standpoint that we maintain our high driver hiring standards and keep our current hiring practices in place instead of trying to bend in order to fit drivers in. So the second thing would be creating a culture of safety. Culture is a pretty big buzzword today, and but I'm really truly a believer in that. Needs to start at the top and be cascaded down through the organization. Is the president showing up at the Saturday safety meetings? Does the president wear his seatbelt when driving his car? It might sound very simple and very stupid, but that's a message that's sent when top management is telling drivers to do stuff, but yet they're not doing that themselves. Setting clear expectations and really setting a culture of safety as a value versus safety as a priority. The third thing would be preventing losses from happening through training and technology. Reacting to losses and identifying root causes of loss. So are we investigating the near misses that happen, or are we saying, ooh, boy, I'm glad we dodged a bullet on that one and moving on to the next thing? I would suggest that in some cases, you may learn as much from those near-miss investigations to prevent future claims as actually investigating the claims that have happened. The last thing I would say is be active in claims management. Communicate with your adjusters regularly. Ask questions. Don't be afraid to call them. Question. Tell them you don't understand. I'm not necessarily advocating confronting them and creating an adversarial relationship, but I think it's important to be in contact with the adjusters after you have claims that are handling the payouts and understanding that. There is value in that process. The last thing would be embrace it. As I said before, the amount of risk that you're comfortable with, you should own, or own as much as you should afford, or as much as you can afford. So ask yourself, what risks are unpredictable, unmanageable, and catastrophic? I would suggest that those risks that are unpredictable, unmanageable, and catastrophic, maybe you should purchase insurance for those. For risks that are predictable, manageable, and not catastrophic, maybe those risks might be better off retained in-house and managed through a risk management program than typically buying a insurance policy to pay that claim out. So the last thing we're going to want to do is determine what type of insurance program best fits your company and your personality. So they're in somewhat of an order from risk averse to willing to take on more risk is they're listed here on the screen. First dollar low deductible. When I talk first dollar, I'm talking about auto liability coverage, and low deductible would apply to, say, a physical damage cargo. So a low deductible for what we see would be anywhere from probably $1,000, $2,500, $5,000 deductible. A higher deductible would probably be, in my definition, something along the lines of $10,000 and above. As you go down or up the scale of risk and taking on more, captives and self-insured retentions are, I would put them on the same level as far as accepting risk. They're just different ways to do it. The self-insured retention would be where you would take on the first X number of dollars of any one loss. And that could be a loss basketed with auto liability, physical damage, cargo. So you may take on the first $15,000, $25,000, $50,000 of any one claim, and you pocket the premium savings by taking that, and you actually pay losses as they occur. Now that does not mean you adjust losses. The insurance company would still adjust losses, but you would pay based off your claims activity. So more loss-sensitive program. A captive really involves setting up your own insurance company whether that be a single parent captive, which is only yourself, or being in a captive with multiple other companies, whether it be homogeneous, being other trucking companies, or heterogeneous, maybe being with some manufacturers or distributors, things like that. Captives and self-insured retentions, we could spend an hour just talking about that. I just wanted to briefly gloss over those programs, talk about those on the spectrum of risk. So long-term risk strategies that we would suggest, some of these we've already covered, would be establishing a strong safety culture, don't compromise driver hiring standards, invest in technology, establishing a strong partnership with both an agency and an insurance company. The agent, trucking is very specific. It's something that is what I would suggest is maybe a little bit more complicated than writing a homeowner's policy. So the agent that you're dealing with, do they have the experience working in the trucking industry? Do they have the proper markets needed to get you a good cross-section of the marketplace for your company? And are they providing loss control and value-added service to help you control and eliminate risk? Now, the insurance company, my suggestion would be, there's insurance companies that jump in and jump out of the trucking arena all the time. And one of the reasons they do jump in and jump out is the high severity nature of trucking. There's some insurance companies that have been long-time stable companies that don't jump in and jump out. Sometimes those long-term companies, you may pay a little bit more, but there's much more stability versus a company that just showed up. They're going to throw you a low rate and they might be gone tomorrow. So some of the things that you're going to want to look at for your insurance company would be claims handling, loss control, underwriting expertise, and experience. So very briefly on claims handling, you think about it, if you've got a loss in Wisconsin where one of your trucks rear-ended a car, may be handled very differently than that same claim that happened in Los Angeles. Does that insurance company have that expertise to handle that claim to the best outcome in both venues? We would also suggest measuring your performance, actively managing the claims, and then putting some skin in the game. So we're getting towards the end of the presentation. Why don't we add a couple of frequently asked questions I'll just address. One of the questions we hear is, why does an insurance carrier need my financials? The answer is an insurance carrier is looking at your financials for two different reasons. The first one, and probably the least important, would be to gauge your ability to pay your premiums. The second reason why they would want to take a look at them, and probably the more important one, is the underwriter is addressing and assessing your overall risk. And a company that is running, not making money, in danger of going out of business, is most likely a worse risk than a company that is making a profit. Let me explain. A company that's in danger of going out of business due to their financial condition is probably going to push their drivers harder, probably going to maybe cut some corners with mechanics, with maintenance, maybe safety, maybe equipment. We may push out that PM that should be done for another X number of miles. So when the underwriters are looking at financials, they are really looking at those to help give them a more broad view of your company and the risk involved with your company. The second question we hear all the time are we in a hard market or soft market? This is a pretty interesting question because right now in trucking, I would say we're probably not squarely in either. A soft market where insurance carriers are looking to cash flow underwrite we really haven't seen a real strong soft market for probably 3 to 5 years. And a reason for that is the effective interest rate is essentially zero. The insurance companies are not out there investing most of their stocks like Apple or eBay or Facebook or things like that. They're in conservative investments, and which is a good thing as required by regulators. With interest rates being so low, it's very hard for them to make money on the investment side to mask underwriting loss. In some areas, the market on the truck side is a little bit more firm than others. So for example, on cargo, right now there's a bunch of monoline, which means that's all they're looking to write, cargo markets. So there is competition in the cargo market right now, as opposed to maybe on the other side for long-haul truckers. There's only a few auto liability carriers out there that are really strong alternatives. And also, we talked about it briefly before, say for a flatbed carrier on workers' compensation. There's not an abundance of markets out there that are really looking hard at writing a risk like that. So I'm kind of straddling the fence on this question. I would probably argue that we are in a firm market, but I certainly wouldn't call it hard, and I'm not sure, I know I wouldn't call it soft. So the next question is, why do insurance rates matter? Or I'm sorry, why do interest rates matter to insurance rates? And I touched on it a little bit before in the previous question. Insurance companies make money two ways, in both underwriting and investment. So when the interest rates are effectively zero, the investment income as realized by insurance carriers certainly is not as great as when the interest rate may be at 5%, which helps them mask any underwriting loss. So interest rates right now being so low, I mean, we are in a lot of cases, we are in a risk underwriting mode because the insurance carriers cannot necessarily mask that underwriting loss. The last question we'll talk about, and then we'll open it up, is it best to shop the market every year? My answer to that would be probably not. Going back to that example we talked about where you as a trucking company got a bid package from a very large prospect, and every year you keep seeing the same bid package and you never end up getting it. It's no different in the insurance community and with an underwriter. I may suggest that it's best to shop every 2-3 years and get some stability, find the right carrier and the right agency, and ride that for perhaps 2-3 years instead of going out there and shopping the market every year, which causes fatigue in the underwriting community to your account. So with that, if anybody's got any questions, we'll open it up. Give you a second or two if you're typing. Okay, well, it looks like that's it. we'd like to thank you for participating in the webinar today. On behalf of HNI and Wisconsin Motor Carriers Council of Safety Supervisors, we appreciate you listening in. If you do have any questions, feel free to contact me at hni.com. I'm listed there. My phone number, my contact information. Be happy to talk with any of you individually. Thank you very much and have a wonderful afternoon.